Enterprise value does not translate equally into what you put in your bank account. And I think it's critically important. There's certainly price and terms considerations that you need to think about. Hello and welcome to this week's Shoot the Moon podcast, broadcasting live and direct from Revenue Rocket World Headquarters in Bloomington, Minnesota. With me today are my partners Ryan Barnett and Matt Lockhart. Welcome, guys.
Great to be here as always. We're starting to get sort of towards that time of the year where we're shutting things down. Although exciting that we've got a couple of deals closing before the end of the year. And for those of you who may be new to the podcast, we are your M&A advisors for tech-enabled services companies worldwide. And Ryan leads the parade and has come up with a heck of a series. Ryan, I think it's going great. How are you?
Yeah, hey, thanks, Matt and Mike. Thanks for being on here today. Today, we're on our fourth episode, really, of a Masterclass series that's really focused on IT services executives and the potential of selling your firm. So when you look towards 2026 and what does that mean for you as an executive in looking at perhaps monetizing your life's work and the biggest asset that you have and perhaps taking that next step, we want to make sure that you are thinking about it in a way that helps get you the most value and helps give you some reassurance towards we love talking about this topic. And so far, we've covered things about how to get ready, how to organize your business, and valuations and what to expect for a valuation. And today is the continuation of that of once you have a valuation in mind and you understand what your enterprise value of your firm could be, the next question that many CEOs ask is, what's my take home? So today we really want to take a look at what are the biggest factors that are impacting the amount that goes into your pocket after a transaction. Mike, I would love to have you get us started. And when you think about these deals, you think about that enterprise value, and that's kind of that headline number. Why do sellers fixate on that? And why is it dangerous to have just the enterprise value as your goalpost compared to the net proceeds?
A great question, Ryan. Enterprise value does not translate equally into what you put in your bank account. And I think it's critically important. There's certainly price and terms considerations that you need to think about, whether you're experiencing what portion of the deal proceeds as cash, what portion is maybe earn out or seller note, what portion has to go to tax. Certainly there's a large amount that goes to fees, right, to advisors and both on the tax, legal, and M&A side that I think, shouldn't be underestimated. And you do have to reconcile all of your debt. I think that's an important thing to note. If you have debt on your balance sheet, it's usually, when we think about these transactions, they're usually structured as cash-free, debt-free transactions. What that essentially means is that, you will be able to have a cash harvest of excess working capital. Not all cash or all working capital necessarily, but certainly excess working capital. And, you have to reconcile all of your debt. And so all those things sort of come out of, for lack of a better term, come out of enterprise value, especially on the liability side. Certainly it's offset some by your assets that you can harvest from your balance sheet. The only time you can really effectively do that is when you sell your business. So, that's on the plus side of the ledger. But the important point here is that the enterprise value number is really not the number ultimately that you end up putting in your bank account.
Yeah, thanks for getting us started there, Mike. I think a lot of the rest of the podcast does focus on a lot of the areas that you just hit on. Great idea. Just understanding that top line doesn't necessarily equal the bottom line and what that means. So, Matt, if you could help define this a little bit more, when you think about kind of gross or net gross proceeds versus net proceeds, can you simplify that for just how a CEO can understand what that means?
Sure. that gross proceed would be that enterprise value that Mike was referring to. And it's sort of the headline number on a letter of intent, right? So the enterprise value, and maybe we just use this as an example moving forward. The enterprise value of your firm is $20 million. It could be $50 million. It could be $100 million, but let's just use $20 million. And that is what you see as that big headline number. And then you need to understand, right, that there are going to be reductions from that. Oftentimes the largest reduction in terms of reduction to what you are going to take home is the debt that is going to be paid to Uncle Sam, right? Taxes. And one of the things that we'll talk about moving forward is how do you plan forward to reduce that amount? But that is going to be there regardless. So from that enterprise value or that headline number, reduction of taxes. If you are carrying debt on the books, as Mike talked about, 99.9% of transactions that we see in this space are cash-free, debt-free transactions. And that means that if you are carrying debt that is above and beyond the assets that you have in your business, that you're going to need to pay off that debt. And oftentimes that can be done as a reduction from that enterprise value at the time of a transaction. It could be cleared beforehand, but that is certainly a reduction as well. And then Mike talked about the potential for working capital adjustments as well. And we can get into that in a little bit more depth, but it is a market-based understanding that a certain amount of working capital will be left in the business so that the buyer can continue to operate the going concern for a period of time. And so there can be others. If you are engaged with an advisor, you're going to need to pay off that advisor. You're going to need to pay off your legal team and the like. And so those are sort of the major things that occur and become the net proceeds, the take home, if you will, as you execute the sale of your business.
Really helped out, Matt. So if I heard you right, you've got some major categories that you're going to have to pay attention to. So I heard debt payoff, heard some advisor fees, heard working capital true-ups, heard taxes. Mike, are there a few other things that someone should start to account for when it looks at the deal overall and what kind of fees you might be expecting?
Yeah, I mean, oftentimes, this is certainly there may be some advisor fees that you haven't thought about that I think are important. And I think what's critically important that you want to be able to have, competent tax counsel. And, I know we've talked a little bit about this in the past, but, super, super critical, important situation, particularly if you're rolling over equity or you have earnouts or in many ways you're deferring tax on those portions of the proceeds. And I would tell you that a competent tax counsel on about how to structure the deal pursuant to be most tax efficient and the timing of those payments, even if it's cash, are important. There's some nuance at the end of the year, like you can certainly get some more effective tax treatment for when you take proceeds from the purchase, and a solid tax advisor is certainly something that is you're going to need, but also that comes at a cost, right? So I think when you think about what costs might occur, certainly there's financial advisors. Usually this is the biggest single asset on your personal financial statement. So, when you start to get this income from a transaction, what are you going to do with it, right? How are you going to invest it to be able to fortify your life and support, where you want to put those proceeds and how to gain the greatest return. And again, back to tax efficiency, there's all kinds of things on the financial advisor side that, should be considered. And we think it's important for you to, talk to those advisors and pay those fees well ahead of time in order to be prepared. It's an area where certainly there can be some blind spots, right? Likewise, when you take a working capital harvest, if it's material, that can certainly impact your tax situation. And there's ways to structure, how you deal with the working capital to be more tax efficient. And again, I think, being able to think about how to optimize take home and be able to optimize, both taxes and debt and how you manage working capital harvest are critical.
And Mike, just to stick with you for just a second here, one of the things that you mentioned earlier was the deal structure. And so I was hoping you could expand a little bit about that. But I was also curious if you could help fill us in on, are there other things that might defer a payment? And specifically, I'm thinking about like a holdback for reps and warrants, in which there's things that may defer a payment until a later date. So it may not be that your take home is less, but that take home might happen at a different time. Can you expand a little bit on that?
Sure. I think it's super important to understand that, if you're a buyer, if you sort of walk a mile in the buyer's shoes, you're going to make all kinds of representations and warranties in a purchase agreement about the fitness of your business or things that have occurred or not occurred, right? And that kind of puts your money where your mouth is pursuant to everything from your books to your contracts to your relationship with vendors to, all of that, right? And you're gonna have to represent and warrant that what the buyer is buying is accurate. But in order to do that, typically a buyer will want some sort of holdback or set off or escrow to make sure that they don't discover anything that comes out of the woodwork, if you will, after close. That you represented or warrant to be one way, that it's another way. An example for that might be a large client gave you notice, prior to close, and you didn't, someone didn't disclose that. Whether you knew about it or didn't know about it, it didn't get disclosed. And now what the client thought they were buying is not what they actually were buying. And if you were to have violated, for example, that representation or warranty, the buyer would have a case, and they want to hold back some money to be able to fortify that. And you think about what that holdback is for, it's to fortify against a breach in the contract. So as long as you're truthful and honest and fully transparent, this generally never comes into play, and you'll always get your holdback. There's really only two ways to fortify reps and warrants. You either get reps and warrants insurance, which is typically written on deals that are, I would say, on the smallest end, more than 10 million in enterprise value, and it can be up to hundreds of millions in enterprise value. Our reps and warrants insurance policies are available to basically fortify that what the reps and warrants say are accurate, and if there's a claim, the insurance company actually pays the claim. So usually in that case, both parties pay a portion of the premium if you can get that reps and warrants insurance, and that's one way to do that. A more cost-effective way, however, is to do this holdback concept with an escrow. Usually it means you are, as a seller, waiting for some of your money for 6 months to a year, but you will get it in most cases, in almost all cases, provided you've represented and provided the reps and warrants in an honest way.
And that really helps. I think the big message here is to understand that there may be things that a buyer puts in the purchase agreement that may have the deferred payment. So it may not be today, but you may see things like that reps and warrants come back to you. You may see contract terms like a seller note that will pay you interest on your money that you're letting the borrower essentially borrow from you. So there are things that are positive in this, and things that buyers are using for protection, and just understand that those are. If I was to take Mike and Matt, if I heard some major categories here, your debt payoff, your M&A advisor, your legal advisor, accounting and tax advisory, you may have something like a Q of quality of earnings report that a buyer may require. That's an optional one that we have certainly seen that. You've got a working capital true up. You've got your tax, and then you've got some reps and warrants holdback. So again, there's a number of categories in which are going to reduce that enterprise value down to what you're going to take home. And a lot of this is largely dependent on the state that you live in. For example, for taxes, is going to have a big difference. Ensuring the right tax planning strategy is critical to success. Matt, I'd love to switch gears a tiny bit. And if you think about the fees that are here, a lot of them are really important. Can you help me understand why advisor fees actually increase the net proceeds, necessarily reduce them?
Well, sure. Advisors, both what we do as your teammates in finding you the very best cultural and strategic and financial fit for your goals, but also your legal advisors and your tax advisors are able to ensure that the very best deal for you as a seller can be achieved. And so what are the means in which, we do that, right? So from our role, we are ensuring that we're going to find that very best strategic fit, and strategic fit above and beyond all, really creates the greatest value, right? It creates the greatest price. Now, also, competition matters. And so by working with a strong and credible M&A advisor, they are going to be able to run a process where multiple people see that strategic fit, to multiple buyers see that strategic fit to their business. And they are going to put their very best foot forward. So in almost all cases, when working with our clients, we're able to achieve an enterprise value price that well exceeds the fees that will be paid to us as an advisor, and most often to us and all advisors, right? Likewise, working with a credible M&A attorney, they are not only going to reduce your ongoing risk, but help to structure the final purchase agreement in such a way that you're maximizing your return. And then finally, just reinforcing what you've said, Ryan, ensuring that working early with a tax advisor that has experience in this space and is able to work with us as well as legal representation to ensure the appropriate structure of a deal is absolutely critical. And so, by working with these professionals, we're increasing the price and we're structuring the deal appropriately to maximize that take-home pay. And done correctly, it well pays for the use of the advisors.
Yeah, well said. And the next topic I think an advisor should be able to help you with, and Mike, I'd like your thoughts here. Now, the question I have is, when you think about the transaction and you set in a letter of intent, there's an enterprise value that's set. What should owners be cautious about reducing that enterprise value in the process? And also, if you think about, for example, in a quality of earnings report that comes back, a buyer might question, EBITDA add back. So this somewhat goes to my question: how does enterprise value start to decrease? But also, what should sellers expect kind of post transaction? Are there things like a true up, or are there things that you may find that are done, perhaps months or even years after a transaction?
Yeah, good question, Brian. So it's not an uncommon, I wouldn't say it's common or uncommon practice for particularly financial buyers to do a quality of earnings analysis. They need to have that done in order to fortify their financial review process and approval to make the investment in your firm. And part of that process will look, think of it like a financial audit. They're going to look at your books with a lot of scrutiny, including your quote unquote add backs to EBITDA, which may include things like owner add backs and other things that you may have put in. And there's generally always a negotiation on what's an appropriate add back or not an appropriate add back. Likewise, there's oftentimes things that are frankly just wrong in the financials, and you'll have to, look at that, whether that be timing problems or issues with how a transaction was posted pursuant to a contract or whatever that may get cause to put a certain amount of profit in question. And as a auditor works through a QV to kind of move down EBITDA, most of these buyers are buying your firm based on a multiple of EBITDA. They use that as sort of a benchmark. And they'll use that to try to retrade your deal or try to negotiate a different price, frankly. To Matt's point, that's why you have a competent advisor, one that can do what we call diligence defense, that can defend your numbers against an audit. Essentially what that is in our firm, it's another auditor who we've already looked at your numbers. We already have comfort that we can defend your number, your EBITDA number, against any challengers. And so should that come up, you really need that, firm, that advisor, that M&A advisor firm who does that in your corner to make sure that the numbers that you put on the board for EBITDA are defensible so that you don't have those numbers to kind of push down or force a potential, retrade in a deal. And so, diligence defense is a big deal in it as it relates to, how do we keep, the integrity of our numbers as put forth in running a sell side process. Now, if you haven't gone through that exercise prior to entertaining a buyer, and you have some of these, what we'll kind of call chinks in the armor, maybe you put an add back in that wasn't completely defensible or normally would be considered an add back, you start to create a momentum of reducing what the profit is. And I don't want to put too fine a point on this, but you just need, professional representation here in order to make sure that, the numbers you're putting out there, one, have been tested as legitimate in the context of an M&A transaction, but two, are defensible so that you don't have any surprises later. It's part of the reason, in my opinion, why, a lot of deals that are not represented or deals that people go forward to try to do on their own without a credible advisor, very few of them get done. If you're approached by a buyer, it's actually statistically only about 1% of those deals actually get completed. This is an area where a lot of those deals get derailed because the pre-work that's required prior to, agreeing to an LOI with a potential buyer has not been done. And there's not been any stress testing on your financials. And as a result, the buyer starts to pick it apart and, you got a business to run. So you're not necessarily in the throes of the financials, nor have you done the pre-work to be able to defend fully your EBITDA.
Great. Mike, Matt, both of this extremely helpful, I think, for sellers. Matt, I'll turn it back to you for any closing thoughts or anything we may have missed.
No, I think another great topic. And, some people who've been through this before may be like, well, yeah, these are some of the basics. But, we work with a lot of founder-led businesses who haven't been through this process before. And they can sometimes get sideways, if you will, if they haven't been properly prepared. That headline number, that shiny headline number isn't necessarily that take-home number. Yeah, a lot of people understand the taxes aspect, but sometimes don't even understand the intricacies of that tax burden. And oftentimes don't understand the concepts of working capital and working capital adjustments. And really don't understand how some buyers, right, are going to work through that diligence period to reduce the purchase price. And so, these are all really, really important topics. I think the last thing that I might add is that it's really important to be prepared, right? And the preparation sort of mentally and emotionally coincides with what that take-home number can be. And so start early, right, with your M&A advisor. Start early enough with your tax advisor. And then at the appropriate time, start early enough with your legal advisor. And so, we're here. We're looking forward to having many and more of these conversations in the year to come. Mike?
Well, I think with that, we'll tie a ribbon on it for this week's Shoot the Moon podcast. I encourage you all to tune in next week for the next class in the Masterclass on preparing your business for sale. Make it a great week.